Something big is happening beneath the surface of Wall Street. While everyone's chasing the usual tech giants, one fast-growing fintech has pulled off a surprising comeback. Its stock is near all-time highs, but with Q2 earnings coming soon, will it go even higher or slow down? Before you jump in, as we reach 1,000 subscribers in this growing community, we want to share something meaningful as a thank you. We've created a free guide, a concise resource that breaks down the strategies top investors use to find high-potential opportunities in the market. You'll find the download link in the description below. If you find value in this video, don't forget to like, share, and subscribe so you don't miss out on potential opportunities. Alright, starting with SoFi Technologies, ticker symbol SoFi, a major player in fintech that's been making significant waves. Currently trading at around $22.09, SoFi is nearing its all-time high. However, with Q2 earnings coming up soon, the big question is, buy, hold, or sell? Let's break it down. SoFi has built a reputation as a digital-first financial platform, combining lending, banking, and investing to become the Amazon of finance. The fundamentals are presenting a much stronger story. However, first here are the financials. In Q1 2025, SoFi reported $764 million in revenue, representing a 24.4% year-over-year increase, and it exceeded expectations. EPS reached 5 cents, a 150% increase from last year and 25% above consensus. Even more impressive, it's exceeded revenue targets for 4 consecutive quarters. So, what's weighing on the stock? At over $22, SoFi trades well above the consensus target of $13.82 and currently receives an F rating on valuation from Zacks. But is that premium justified? Let's explore further. Growth engine checkpoint. SoFi is operating at full speed. In Q1 alone, it gained 800,000 new members and launched 1.2 million new products, a strong sign of momentum. Management projects Q2 revenue between $785 million and $805 million, representing a 31% to 34% year-over-year increase, with EPS of 5 to 6 cents. Analysts are at the high end of that range, signaling cautious optimism. More importantly, SoFi isn't just growing, it's transforming. The company is rapidly transitioning from capital-intensive lending to fee-based, capital-efficient segments, such as its technology platform and loan platform business, LPB. As July 29th approaches, investors will be closely watching to see whether SoFi can maintain this trajectory or if the current valuation will be questioned. So, is SoFi a good buy at these levels? A stock price that has increased nearly 179% year-over-year, prompting caution. SoFi is progressing rapidly. If Q2 exceeds expectations, the potential gains could increase. However, after such a sharp rally, the stock might be valued for perfection. This upcoming earnings report becomes a crucial moment, not just for traders, but also for long-term investors. So, the decision? Lean in, but don't look away. The next stock that has the potential to 2x your money is Applied Digital ticker symbol APLD. This stock has emerged as a silent infrastructure powerhouse riding the AI wave. Initially focused on crypto mining facilities, the company has successfully repositioned itself into high-performance computing, HPC, and AI cloud hosting, two of the fastest-growing segments in tech. In 2023, that pivot became reality. The company secured over $400 million in multi-year contracts from enterprise-grade clients, signaling strong institutional demand for its compute infrastructure. These contracts represent locked-in revenue streams, rare for a company this young, and suggest a growing competitive moat in AI infrastructure. Its biggest advantage? Strategic location and cost structure. Applied Digital's data centers in North Dakota and Texas are built around low-cost energy and rural land, which lowers operating expenses and improves long-term margins. These edge markets also offer favorable permitting and access to renewable energy sources, giving Applied a unique operational edge. To meet demand, Applied is scaling fast. The company is building multiple data center campuses and recently completed a large-scale HPC facility dedicated to AI workloads. Management has made it clear, this isn't about speculation. It's about becoming the digital backbone for AI companies priced out of hyperscaler solutions like AWS. Applied Digital now trades at a market cap of approximately $2.47 billion, a clear move up from its microcap days. The market is starting to acknowledge the company's traction, but it still trades at a significant discount compared to legacy players in the data infrastructure space. With a growing backlog, robust contract pipeline, and strong AI tailwinds, A future valuation of $4 to $5 billion is plausible if execution continues and profitability scales. That represents a near 2x upside from today's levels. More importantly, Applied sits in the picks and shovels category of the AI boom. While chipmakers like NVIDIA and AMD are well covered, data infrastructure players like APLD are earlier in their growth curve and often overlooked. APLD has seen a strong run in 2024, with a year-to-date return of 43.79% and a one-year return of 77.18%. That performance places it among the top-performing infrastructure stocks in the mid-cap space. The stock currently trades around $10.97, holding well above its 50-day and 200-day moving averages, which suggests sustained bullish momentum. The next critical resistance is in the $12 range. A breakout above that could set up a run toward $14 to $15. The optimal buy zone for Applied Digital, APLD, is between $9 and $10, particularly during pullbacks or broader market dips. If the stock remains in the $10 to $11.80 range, it's considered a solid hold as it consolidates with upward momentum. A confirmed breakout above $12, especially on strong volume, would signal renewed bullish sentiment and potential upside. Should the stock push toward $14 to $15, it may enter profit-taking territory if the price begins to outpace current fundamentals. Applied Digital isn't just another AI-adjacent stock, it's quietly becoming the physical infrastructure powering the next phase of the AI economy. With a growing client base, rising contract value, and a capital-efficient business model, the company is proving that scale and profitability aren't mutually exclusive. For investors looking to gain exposure to AI without chasing trillion-dollar valuations, APLD offers a high-conviction, mid-cap growth opportunity with real assets, real cash flow, and real runway. This brings us to the last stock. Rivian, ticker symbol RIVN. The stock entered the EV race as one of the most hyped IPOs in recent memory. Since then, it's been a story of expectations meeting reality. But recent developments suggest Rivian might be turning a key corner, both operationally and strategically. The company recently announced a new manufacturing platform, the R2 platform, targeting the midsize EV SUV segment. Unlike the original R1 series, which came with a luxury price tag, R2 is Rivian's first attempt at mass market scale. Production is expected to begin in 2026, but investor sentiment has already started to price in the long-term potential. On the fleet side, Amazon, a major investor, continues to roll out thousands of Rivian delivery vans, fulfilling part of a long-term agreement. These commercial vehicles provide steady revenue and help Rivian balance out its consumer production challenges. With a $14 billion current market cap, Rivian trades at a fraction of its former highs. For context, Lucid is valued similarly, but Rivian's delivery numbers, product mix, and commercial deals arguably put it in a stronger operational position. If Rivian successfully executes its R2 strategy and scales operations to profitability by 2026-2027, a market cap between $25 to $30 billion is a reasonable long-term target. That implies a 2x potential from current levels. On the technical side of view, RIVN currently trades around the $12 range, depending on recent sentiment shifts and macro headlines. The stock has found repeated support in the $11.50 to $13 zone, which could represent a zone base. Investors should consider accumulating Applied Digital stock in the $12 to $14 range, especially during periods of market weakness. If the price moves into the $15 to $17 zone, it becomes a strong hold as you monitor for resistance breakouts, updated revenue forecasts, or volume surges. For those already positioned, the $20 to $22 range, this presents a logical profit-taking zone, as it aligns with historical resistance levels and the stock's highs from 2023. If broader EV sentiment improves and Rivian shows quarterly improvements in cost control and delivery scale, expect renewed interest from both retail and institutional players.